Brad Williams, Frugal Finance, creating hybrid fixed floating debts. Considering an industrial firm with an outstanding floating rate note paying SOFR plus 2% semi-annually, a remaining term to maturity of 6 years and a par value of $30 million. The issuer has decided that it would like to fix financing costs for the first 3 years of the remaining maturity, while allowing the rate to float for the remaining 3 years. A brute force approach to this need would be to purchase all of the existing bonds in the open market and issue a new bond that has the preferred features of fixed rate for 3 years, followed by a floating rate for 3 years. This course of action would be quite expensive and difficult. First, a bond buyback is an expensive undertaking in itself. Second, the firm would have to register and issue a new bond, incurring substantial registration fees and flotation costs. Third, the firm might have difficulty finding investors who would want a hybrid fixed floating bond. Through the swap market, however, the firm can realize its desires efficiently and at a low cost. The firm can change the structure of its debt by leaving its existing floating rate notes intact and entering a pay fixed interest rate swap. Specifically, the firm initiates a swap to pay a fixed rate on $30 million with semi-annual payments with a tenure of 3 years and to receive SOFR flat. Assuming the fixed rate for such a swap is 6%, the firm will have fixed its financing costs at 8% for the first 3 years, while allowing the rate it pays on the bond to float for the last 3 years of the FRN's life. The firm's fixed rate financing cost is 8% because with the swap agreement, the firm pays SOFR plus 2% on its FRN, receives SOFR flat on the swap agreement, and pays 6% fixed on the swap agreement. We illustrate this transaction by focusing on a single payment, since all 6 of the semi-annual payments have the same structure. Semi-annual cash flow on outstanding FRN. SOFR plus 2 times half a year times $30 million. Pay fixed swap semi-annual cash, 6% times half year times 30, the negative means you're paying, plus SOFR times half year times 30 million. Net semi-annual cash flow, swap flows plus outstanding forward rate note. SOFR plus 2% times half year times 30 million minus 6% times half year times 30 million plus SOFR plus half year times 30 million equals negative 8% times half year times 30 million equals negative 1.2 million. There it is right here. When you weigh the challenges and costs involved in buying back bonds and issuing new ones, it becomes clear that swap agreements offer a much simpler and cheaper alternative for achieving similar financial outcomes. This scenario highlights the practical appeal of the swap markets today. Swaps offer a cost-efficient and streamlined way to adjust financial positions, which could otherwise require more resources and time. Nowadays, the attractiveness of the swap market largely stems from its ability to streamline my operations rather than from attempts to capitalize on informational gaps. The question is, why, if you're the CFO of this company, why would you initiate this? Brad Williams, Frugal Finance. See you soon.